Here are some investing keys. When people first hear about the stock market and investing in the stock market, they immediately get extremely antsy and figure out that it's some get rich quick scheme. But there's no such thing. There's no real way to make money without learning, without being knowledgeable, without being educated, unless you have some natural skill level or some connection. So same thing with the stock market. There's no way, nobody can tell you which way to go, which direction to go, and how to go unless they have a specific plan designed around your needs and wants. So even if you were talking to an active investor, they can't ever point you in the direction on what to buy and when to buy it, because there's a whole framework involved and whole guidelines law that you must check off to really be in some good investments. As I've mentioned in my previous videos, passive investing is the safer route to go for most people who cannot focus on the markets, geopolitics, innovations on a daily basis. If you're passive, it's all about consistency and following through with a long-term game plan. With passive investing, you're going to be investing in ETFs, you're going to be investing in index funds, you're going to be investing in Roth IRAs, and that'll be your focal point until you're ready for retirement. And that's the safest and simplest way to invest and build wealth. Now, for active investors, it's a whole nother game. And going forward on in most of my videos, that's what I'm going to be focused on, because I think I've given enough information for somebody to be a passive investor and end up extremely wealthy when they get to the age of retirement once again. But not active investors, it's time to go to work. For active investors, the learning cycle never stops. It's a whole nother beast. Once you decide to become an active investor, it's essentially like getting a master's degree and working your way up to a PhD with no guaranteed tenure at the end of the road. Only wealth destruction or wealth accumulation. To be a successful active investor, you're essentially fine-tuning your journey into a mix of art and science. The structure of investing is not a guaranteed formula. There's too many factors that are intangible that interrupt the tangible for you to say it's always a science, my format is always perfect, my steps are always in tune with what the market is doing. There's no such thing. It's all about analyzing, fixing your old methods, and implementing the methods that you are successful with. To survive being an active investor, it's just not about stock picking. It's about learning about the entire enterprise ecosystem. So the enterprise ecosystem has the core company, which you're looking to invest in, and is essentially a top tier player, a global provider of products or services. Now, the ecosystem around is the manufacturers, the suppliers, which are fine-tuned over time through a manufacturing process. But these companies that are sitting at the top can always renegotiate with other partners or previous partners their terms and conditions, where if they're going faster, they can have multiple companies doing the exact same thing within the ecosystem based on their budget and basically whatever the CFO decides is best for their finances. An example would be Apple, where they're sitting at the top. They have their technology hardware like iPhone, MacBooks, iPads. Then they have their shared technology partners. These are people who basically work through the cloud network and data and have the infrastructure that keeps their products going, providing their software integration with their hardware. And then you have the people who are making the apps within their ecosystem, the software developers, the coders. So all these people are part of the ecosystem that help you narrate which way this company is going to go. Is it going to go up or down? Is the stock price maintaining? Is it going to continue to grow? Is it going to have losses? Are they going to end up deciding if they want to give dividends? Are they going to buy other companies? Is it going to go sideways for a while? There's going to be no type of reaction. There's just so many different factors that you have to understand. The main thing is everybody in the ecosystem is like working like a team. So they win together, they lose together, they try to help each other out when issues come out, because they understand that the supply chain has to keep flowing. Whenever an interruption comes, it's a team effort to kind of resolve these issues, because at the end, the big players are going to get hurt, but they also have the most power, the most capital, basically the most flexibility to work with their suppliers and within their ecosystem partners and resolve issues. And that's how you know you have good management, when they're looking for problems and solutions constantly, even if it is outside their company but within their ecosystem. And here are 3 investing experts and leaders that you must get to know. First, we have the legendary economist Paul Krugman. Second, we have is Daniel Kahneman. Third, we have his collaborator Amos Tversky. To help an active investor navigate through his journey, their ideologies and their systems and their studies have exponentially given a boost to investing understandings when it comes to behavioral psychology, when it comes to economics, when it comes to market cycles, and when it comes to supply chains. Paul Krugman is extremely instrumental when it comes to understanding macroeconomics, world trade, and global policy. He's one of the top economists that has been completely against majority of Trump's policies, especially when it comes to tariffs, global outreach, and partnering up with allies and non-allies. He's also spoken on tariffs. He speaks on this interconnectivity of globalism and nationalism. He's one of the economists that you can say it truthfully wants to see the entire globe prosper and still see the U.S. succeeding as the top nation. Kahneman and Tversky are the fathers of behavioral economics. Their work is globally renowned. Their research is still tapped into by other experts who use it to source some of the great other works that have come out over time, which have basically delved into a lot of other topics. Over time, we have realized how important behavioral psychology is to everything we do. And people might be wondering, why is this important to the stock market or somebody who speaks of economics, investing, and geopolitics? The reason is it's just not about number and data. It's also about a lot of human reactions to the market and to economics that allows you to kind of decipher and make decisions. And if you read the book that I've written, which is called Thinking Fast and Slow, it's going to change your whole life on how you think about things, how you process things, how you analyze things, your heuristics. It's also on how you can break them down and execute them. Because the way the mind works is we think fast and slow. Basically, that's what the title of the book is. So kind of, sounds dumb when I'm saying it. But essentially, that's how our mind works. There's certain things that we grasp onto really fast that are reactionary based on reflexes. And there are other things that require deep thought, sitting back, analyzing, breaking down. But we need both of these structures because essentially, if you go to human history and see how we develop, if we didn't have those reactionary reflex abilities, we might not exist because we needed those when we were living in the jungles, when we didn't have civilization. And over time, the advances we made, we would have never made without the slow thinking. So the combination of the two is required, and understanding how they work allows you to evaluate a lot of things much more clearly. So I think everybody should read this book and implement it into all parts of their lives. So always remember, the market just doesn't move on numbers. There's a lot of human psychology involved, whether it's greed, whether it's impatience, whether it's cognitive biases, whether it's fear. Essentially, if you don't know how you think, you'll never know how the market truly moves. Here's the stock market for the week of May 18th to May 22nd, 2026. S&P 500 is up 0.88%, Nasdaq is up 0.41%, Dow Jones is up 1.12%, Russell 2000 is up 2.45%, gold is down negative 0.15%, crude oil is up 2.73%. In the last couple of weeks, we've seen a lot of fluctuations within the market with the market breadth issue, a lot of concentration, and a lot of the new IPOs that are coming out. Essentially giving the market a little bit of boost, but at the same time, people pulling out and maybe reinvesting into other smaller caps and mid-cap markets because, once again, market breadth is concerning. With all the depth issues in the macro sense that we have and the war, looking at this concentration, we see one brick come out, the whole building comes crashing down. With how private credit works and preliminary investments into a lot of these startups goes, the IPO scene has been weak in the last 5 to 8 years. But now we're getting a $1 trillion IPO test with companies like SpaceX, OpenAI, Anthropic, and later Stripe coming into the market. It's going to be a whole new movement. It's going to change indexes, it's going to change ETFs. We're just going to see a whole new shift in how money flows in and out. Because essentially, for companies with such large sizes like this, the previous money that's in the market will have to come out to be reinvested into these. So we're going to see a type of rebalancing. The major issue is this is going to cause a whole nother level of market breadth issue, because these companies are already the top players in the game or funded by the top players in the game. Like if you look at OpenAI, they're funded by Microsoft, which is one of the companies that is part of the market breadth issue. So if they're going to be investing in OpenAI, which is going to be joining the IPO, which is going to require these big firms to pull money out of other stocks to put it into OpenAI, essentially they're also investing in Microsoft more. So this is more than likely going to cause a type of a massive liquidity black hole, just sucking money into these larger companies that have trillion-dollar valuations. With some have losses, some are losing growth, and others are booming within a specific niche. So let's see how retail investors, which is the public, ends up flowing money into these companies, because there's a lot of cult following for all these companies. So it's going to be a shakeup for sure. SpaceX went ahead and filed their S1 prospectus looking for their IPO filing. And it came out to be a little shocking how quickly they're moving. And the metrics are revenue is growing at a blistering speed, exited 2025 at a $20 billion run rate, but their adjusted operating margin is a staggering negative 122%, meaning they lose $1.22 for every dollar they bring in. They project burning through $600 billion before hitting profitability in 2030. And then we have OpenAI. They're looking to file to essentially before the year ends, they would like to be public. And we all know about the legal issues that Elon Musk has with OpenAI, with it being a non-for-profit and then transitioning into a for-profit once they got an investment from Microsoft. So that legal battle seems like it's kind of fizzled away. And with the IPO filing of both SpaceX, which is already integrated into the AI company that Elon Musk built, basically SpaceX, they've merged into it. It was losing so much money. Elon was like, let me just buy them out, so I don't have to file for bankruptcy. That's part of the market breadth issue also, is that Elon Musk has found a complete money glitch. Anytime one of his companies starts losing money, he finds outside investors from Saudi Arabia or UAE, buys the old company out that's not making money and includes it into another company which is supposed to have a TAM of 30 trillion. So the metrics for the OpenAI IPO are essentially they're targeting a June listing as early as June 12, aiming to raise up to 75 billion at a valuation of between 1.75 trillion to 2 trillion. If priced here, it blows past the Saudi Aramco's 29 billion record to become the largest IPO in human history, which is one of the biggest oil reserves in the history of the world. I mean, the amount of tangible assets that Saudi Aramco owns in comparison to what OpenAI owns and what it's doing, like it almost seems illogical. But we're looking at future growth, we're looking at TAM, and that's like really the main reason these IPOs are so ballooned up. Some of the other numbers are growth is shockingly cracking for ChatGPT, recently stalled at 900 million weekly active users, missing internal targets. There's a slight panic within the company with top management saying even though the IPO is coming, it doesn't necessarily mean something. I mean, it seems like they're a little shaky about it, but with all the investments that we're making into these data centers and the infrastructure of the U.S., this has to work. I mean, there's no guarantee in how quickly these companies are going to profit, how much they're going to continue to grow. But if you're investing in them, it's just a long-term game. And then we have OpenAI's second biggest competitor, with the first biggest, I believe, being Google and Gemini. The third biggest is Anthropic. They're looking to go public as soon as possible at a $900 billion valuation. to basically compete with OpenAI. What they've done is extremely impressive. They've focused more on the enterprise setup of AI, and their numbers are crushing everybody's right now. Their products are looking better, especially when it comes to code work and more professional level work. They've been integrated really well with programmers, coders. It's the preferred learning model for most of these coders to use. So the professional level of usage within Anthropic does guarantee faster growth, because at the end of the day, everything works on the tokens, right? So if the people that are using Anthropic are professionals, that means they're using it more, they're juicing it more. So if they're juicing it more, they're also using more money, more of their data, so they're paying them more. Where if somebody who's on OpenAI is just a student using it to get research papers done, homework done, just find basic answers, that's less data, that's less money coming to them. So I think Anthropic does definitely have the upside, and if I were to invest in either one of these two, I'm going with Anthropic over OpenAI. I think they have a more reasonable model, they have a better product, and I like their management better. Essentially, OpenAI's management, they have a lot of negative coverage all around, whether it's internal issues, whether it's issues with the product, whether it's issues with morality. They have a lot of those issues. Here are the metrics for the Anthropic IPO. Anthropic told investors it's on its track to post an operating profit of $559 million on $10.9 billion in revenue for Q2 2026. They're proving that an enterprise-focused AI model can achieve sustainability long before OpenAI can. Anthropic's S1 reveals they signed a deal to spend $15 billion a year on data centers capacity from SpaceX. Once again, market breadth issues. All these companies are investing in each other, working together on the same idea. So other thing with these IPOs is, which is a whole new setup by the Nasdaq, is called the Fast Entry Index, where as soon as these companies IPO, these passive index funds will be forced to automatically invest in them right away. And I just mentioned this earlier, if these IPOs are coming, investors are going to have to pull money out to put them into them because they have such large valuations. And that's exactly what's going to happen with this new rule. These indexes are going to be forced to sell whatever they're already invested in to put money into these large IPOs. So this is going to be the first time that this is happening, and we'll have to see and analyze how this goes. And it could become a legendary mark in history. When we go in the future and look back, it's going to be a thing to study. With the fast entry index rules, JP Morgan estimates the passive index funds will have to force sell up to $95 billion of Wall Street's existing top tech giants like Microsoft, Apple, and Alphabet, just to make room for this new trio. It's a massive structural risk for the rest of the market, but we're already seeing this. The venture capital exit dam has officially broken, and it's going to completely rewrite the rules of index composition by the end of this year. Right now, the level of stocks hitting 52-week highs and 52-week lows is neck and neck, and we don't want that. You want the 52-week highs to be booming, and then the lows to kind of maintaining a level of spread. Like, you want to see people that are in these top mega caps getting some profits and reinvesting them into the bottom half, and that's how you have a good structured market. With this issue, the turmoil can be heavy, and with all this capex investing, these two things are extremely volatile for the market right now. The Fed is in so much pressure right now that we're hearing about rate hikes being something that's going to happen within this year, when before the war, rate hikes, even with tariffs, were not plausible. The economy seemed to be doing well. As far as the wage issues we have, the job issues we have, I feel like it's a tough one. We need to figure out a way to alleviate all these losses we're getting from the AI implementation, because a lot of these corporations are firing people based on saying that it's AI related, and the margins are showing the top companies are well off, where small businesses are deteriorating. So that's why the jobs is such a big issue. And as far as the wage growth and wage separation, I can't talk enough about it, but we all know this. Like, the majority of the population is feeling it. When we look at it, the bottom half only pays 3% of the taxes. So even with that, their income base is not growing. But with the percentages and the tax relief that these top players get, the top 1 percentile gets, it's just unfair and it's not good for the economy long term. The legend Jeff DeGraff also laid out a warning on inflation. He says that our market cycle clock is in a vulnerable space because inflation data remains elevated while economic health is middling. Historically, the worst spot for equity returns. Watch the bond market here. It's a real yield story right now. Rising real yields mean tighter financial conditions. We're seeing that hit gold and crypto, which is actually forcing crypto to trade like a legitimate financial asset based on risk hurdle rates rather than pure speculation. And then his partner in crime at Renmec, Neil Dutta, my favorite business economist, argues that we shouldn't panic about growth leaking abroad through the AI boom. Even if real disposable income is lagging behind consumer spending, the wealth effect from housing and soaring equity prices is picking up the slack. The money circling back into the US tech stocks, profit means the wealth isn't vanishing, it's sustaining the upper tier consumer. Furthermore, Zach Pandel from Grayscale Investments sees the US has a structural risk issue. Basically, Jeff DeGraff was saying the same thing. The US has a massive mathematical, unsolvable political imbalance where virtually all tax revenue is swallowed up by entitlements and interest payments on our national debt. This is exactly why mainstream economists and industry insiders are paying attention to scarce currencies like gold and Bitcoin as structural hedges against fiat debasement, which is a huge concern for the dollar bill because that is the world's currency. If people lose confidence in that and are going towards more gold and Bitcoin and crypto, what does that really mean for the structure of the US and the hegemony it has around the world? Politics and geopolitics is in a complete unstable state, especially due to the US and Trump's cabinet. These guys just want to separate ourselves from the world, which is impossible to do. We're seeing these logjams, we're seeing these supply chain issues, and still they're acting like everything is normal and stable. Domestically, Congress is struggling to do anything. There's a recent article that came out from Wall Street that covers all this. Basically, it highlights that the current 119 Congress has passed a historically anemic number of laws, near absolute historic lows. We just went through a massive month-long logjam to reopen the Department of Homeland Security after grueling shutdown, and public approval of Congress has catered to just 10%, with 86% of voters disapproving. This political dysfunction means solving long-term fiscal debt is completely off the table. Meanwhile, local political battles are heating up, like in Tennessee, where Republicans just approved a controversial new congressional map that dismantles the state's only majority black district, pointing to a bitter midterm cycle ahead. We already know how much racism there is within the system of the U.S. The judge knows the prosecutor and the defense. That's my biggest example. Like, if you've ever dealt with the court system in the U.S., it truly opens up your mind to how connected and how buddy system works in the U.S. Essentially, we're in Pakistan right now. The way Trump is trading stocks left and right while he's in office, the way his sons are investing in crypto while partnering up with Middle East and UAE, and then the cycle of defense contracts. We're functioning like a corrupt third world country, and we always have. The U.S. always has. But there was some type of self-respect in saying that we're chasing freedom, we're chasing diplomacy. Trump, he doesn't give a shit. He tells it how it is. That's the only thing that I admit I like about him, because he's kind of opening up what minorities have always said about the U.S., because we experienced it on the bottom level. So we're not new to this. You guys are new to this. The Democrats are new to this. White people are new to this. The middle level is new to this. And then the uneducated are new to this because they just don't keep up with it. But this is nothing new. What Trump is doing is just at the level which he's doing and the way he brags about it, the corruption is at a third world level for a fact. Even with the issues that we're facing here in our local government, the biggest issues are in geopolitics and how the world is kind of separating, and how this war is designing a whole new format of supply chain and world order. And recently, Washington Post's analysis of a satellite imagery has revealed that Iranian airstrikes have hit far more U.S. military assets in the Middle East than the U.S. government has publicly acknowledged. Satellite data shows that at least 228 structures or pieces of equipment at U.S. military sites have been damaged or destroyed since the conflict escalated. Bases in Bahrain and Kuwait were among the hardest hit, likely because they permitted retaliatory attacks from their territory. So Iran is now looking to back down, and why should they? They're winning. The U.S. looks like they don't know what they're doing, and I'm gonna keep saying that because they don't. We have a bunch of idiots that are running the most powerful military, and they can't unblock the strait that supposedly a country that has no more weapons left, no more navy left, no power at all to begin with. And all this is happening. There's also reports coming out how U.S. and Israel targeted medical facilities, schools, neighborhoods. So Iran's fighting a fair war while the U.S. and Israel are breaking all international laws and still losing. The U.S. hasn't really won a war since Vietnam. Iraq was a failure, Afghanistan was a failure, and now this is a failure. And this is how empires fall. Go study the Roman Empire. They had all that power, all that wealth, but who ended up defeating them? Small fractions all around them. So it can happen all over again. And once again, Ray Dalio's analysis is the best on this, including Why Nations Fail. That's an amazing book to read. I've covered both of those in previous vlogs, but they'll paint the best picture for anybody on what's really happening. All these factors are extremely destructive to our economy, to the global economy, and your personal portfolio. Because weaponized dollar, heavy financial sanctions, and physical conflict are rapidly dividing the world into two distinct camps. Those who can transact in the US dollar and those who cannot. As the world fragments, geopolitical frictions go up, global supply chains face permanent risk. And as the case for scarce, decentralized alternative asset grows, is getting stronger. Same thing with gold. You have to understand the ecosystem. You have to understand the interconnectivity. You have to understand how to resolve problems and move forward and communicate and negotiate. There's no such thing as forcing people's hands in this day and age.